interesting conversation. Let's now take a deeper dive into the topics of the conference today. And here we'd be very happy to hear from you. You will be able to see the Slido details on stage. Please send your comments and questions to that. And for those of you here with us in the Egg, we will have some microphones in the audience. So now I'm delighted to welcome to the stage our panelists for this roundtable discussion. Sean Berrigan, Director General for Financial Stability, Financial Services and Capital Markets Union from the European Commission. Manuel Preto, Deputy CDO of Santander Tota. Birgit Rodolph, Chief Executive Director of Resolution and Prevention of Money Laundering at BaFin. Anneli Tuominen, Member of the Supervisory Board of the European Central Bank. And replacing Jérôme Grivet a bit at the last minute, so thank you to him, Axel Marmotton, Head of Capital and Resolution. And our moderator is Jo Lynham, Business Editor with News Talk Radio. Unfortunately, Irene Tagnagli has sent her apologies. She can't make it. Now, over to you, Jo, and the panel, please.
Thank you very much. Good morning to you. I hope you're all well. Interesting so far. This egg building reminds me a little bit of University College Dublin when I was doing my Bachelor of Commerce. Did you go to that university, Sean? Did you go to UCD? I did. You did. So there we have two. Does it remind you of a bit of Theatre L, Theatre P? Yes, it does. Yeah, the seats are more comfortable here. So anyway, thank you for giving up Carnival to be with us today. I'm dressed as Donald Trump for my Carnival cast. So good, so good. Anyway, the SRB is a bit like a referee in a football game. If he or she is doing his job, you shouldn't notice him. But of course, if someone kicks someone in the face, you should get a red card pretty quickly and the match should go on. Today we're going to talk about the 3 R's of risk, readiness and resilience. And as Susan has already said, it's on the record. There are a few of my journalistic colleagues in the audience and some are watching online, of course. And if you do wish to comment, there was a Slido QR code. Maybe you could, yeah, there we go. If you could put that back up. If you do wish to comment, and I'll get the questions and I will put them to the panel over the next hour or so. Or if you're feeling extra brave, raise your hand. Put your hand up, and we have roving microphones, I think, and we will put them to the audience as well. I think you've already seen in the website the bios of our illustrious panel. Sean Berrigan to my left. Alex, thank you very much for stepping in at the last moment. Thank you very much. So can I say that...
By the way, it's Axel.
So should I give you underarm questions, easygoing questions, because you've joined us at the last moment. Birgit Rodolph, thank you very much for joining us from I love this, Bundesanstalt für Finanzdienstleistungsaufsicht. Thankfully, BaFin for short. Thankfully. And Anneli Tuominen. I don't know what that is in Finnish, but you're definitely a member of the Supervisory Board of the European Central Bank, and thank you very much for joining us as well. Hey, hey. Should I say Kitos? Kitos. And Manuel Preto, the Deputy Chief Executive from Santander Tota. Obrigado. Now, I'm going to start with the lessons from the mini-banking crisis in March last year. We don't even have a full year behind us. I might ask you, Anneli, to start. What did we learn from the meltdown of 3 or 4 regional banks in the US, followed by the swallowing up of a giant Swiss bank by another giant Swiss bank?
Right. Thank you so much. Thank you for the invitation to be here, first of all. The lessons learned, maybe I would like to touch upon the banking side and the supervisory side, because there were not that many regulatory issues. Well, the banking side, I think the main thing was really the lack of good governance, the lack of good risk management. And that applied to banks here on the European side and on the US side. And that's really a key, to have a good board which has both, of course, it needs to be able to speak to the management, but it needs also to be able to challenge the management. Otherwise, it doesn't function. And then there were many failures in the risk management culture, also from the point of view that, like the banks in the US, they were more interested in short-term profits as compared to good risk management, which became a failure. And they didn't really take into account the impact of the increased interest rates, the higher interest rates, and what would that mean from the bank's point of view. And of course, they were concentrating a lot there on both on the asset side and the liability side. And then what happened when the interest rates were high and when the rumors started to flow in the social media, investors were looking at the market value of the bank and then withdrew their money. The one question, of course, that we supervisors would need to look into, and I understand there's also work ongoing at the FSB, is regarding this social media, the very fast move of information, which means that you can withdraw your deposits very quickly. So what can we do? What are the really ways to improve? We can, of course, we can ask the banks to be able to have money available for 5 days, or we can change a bit the liquidity rules. But these things happen so quickly that it really needs to be assessed very carefully. If I may continue, just a couple of points from the supervisory side, is that we supervisors, we would need to be able to move, even though we sometimes see that the capital adequacy level is high enough, there's enough liquidity, but the business model is rotten. So we would need to be able to interfere. We would need to be able to act and not just to be delayed with our actions. And that also happened both on the other side of the Atlantic and here in Europe. What the supervisors also need to assess very carefully is that all the board members are fit and proper, that they know what they are doing. I think those are really the very main things. And then maybe one thing more, that we would need to have more visibility. What would be the impact of bail-in in the world of investors, and how could we actually operationalize bail-in activities? But those are really the main points from my point of view. Thank you.
Can I ask the same question of Birgit Rorov from BaFin? Were you surprised? Let's focus on the Credit Suisse thing first. Were you surprised at how the Swiss National Bank handled it?
I would actually, if you don't mind, I would like to comment on both sides of the ocean.
Yep.
Closer, because if I go one step back, I mean, what did we really see last year? We saw banks which had weaknesses in risk management, in governance, and in business models, as Annelie just pointed out. Unfortunately, none of those issues are really new in the banking world. And then if you go one step deeper, for example, let's take SVB. Yeah? SVB was a bank which hasn't even had a chief risk manager for quite some time. Yeah?
Yep.
So this is, for me, not something which usually should not happen. Yeah? Then they were financing long-term investments with short-term funding. The funding were coming to a super large portion from the venture capital industry. Those depositors had super big amounts of deposits, of course, uninsured deposits, because we have this 100,000 euro limit in Europe. In America, somewhat similar. So this high concentration of funds from a very limited number of depositors. In this little group, basically, I mean, bad news spread quite fast. You don't even need social media for this. Social media is enhancing it, but you can also use just your mobile phone, because basically the people know each other, and other banks knew the group of investors in SVB. So what happened, of course, was the bank run started. The bank had to sell securities under par, realizing losses. Rumors spread even more, and a vicious circle started, and that basically caused the end of the bank. Yeah? Lessons learned from this case, as Annelie pointed out before, on the supervisory side, there really wasn't enough liquidity for SVB. The business model was questionable, to say. And on the resolution side, SVB was growing so fast that the bank just started to prepare itself for a resolution. So there were no dedicated amounts reserved for loss absorption capacity. There was zero. Yeah? Mm-hmm. So if we now come back to your question, actually, which is Credit Suisse. Credit Suisse is in a way similar but also different. Credit Suisse had deficiencies in the business model and also on governance over years, and the industry knew this, and the regulators also knew this. But Credit Suisse had been prepared for resolution for quite some time, and there were TLAC reserves for loss absorption capital were built up. This could have been the first resolution of a GSIB worldwide, actually. You know? And it wasn't. It was a merger solution, let's call it a merger solution. But nevertheless, that the preparation for resolution has been done, and that the loss absorption capital has been built up, that facilitated clearly the merger as well. And yeah, that is my point of view.
Were you surprised at the AT1 issue within Credit Suisse?
I think Dominic made a very clear statement on this, and there's nothing to add.
But that's
yes.
You were watching in Frankfurt. Were you saying, OMG?
No, for me, I mean, we would have started with the equity.
Yeah.
So, I mean, there's a waterfall on the...
Sean Berrigan from DG FISMA. Were you surprised watching, a mile up the road?
I mean, was I surprised by the event? Yes. Was I happy it was solved? Yes. Did I expect it to be solved exactly as it was? Probably not. But I think we have to be realistic here that, I mean, all in all, we were all very happy on the weekend later that something had been done.
Yeah.
And I think all of us need to be a little bit humble that when you're facing those kind of crises, those of us who've sat around tables, and some of us have sat around tables, the most important thing is to get through and to follow the rules as closely as possible, but of course, it's not always possible. So, of course, they didn't do it exactly as the way we expected, but as I said, the most important thing was to get through. Now, from a resolution point of view, what interested me was, however, that even though CMDI had predated any of this, some of the issues that arose, particularly in the United States, although in a very different context, were similar to the ones we were trying to address here in the EU. Mm. So in particular, what happened around the US banks and deposits was deposits began to move and move very quickly. Now, those deposits could have been bailed in.
Could have been, but
they were not. And they were not for two reasons. One, the risk of contagion to other parts of the sector. And secondly, the risk of economic damage to the local economy. And what surprised me was that those were very similar arguments to which underlay the work we did on the CMDI, because it was this very similar story of mid-sized banks which do not have sufficient bail-inable material, as Dominique mentioned earlier, and therefore are left to bail in deposits, very often are not able to bail in those deposits for those two reasons as well: contagion risk and economic damage. And that means they turn to the state, as was the case in the US. They turn to the state. According to the principles of the BORD, we are not to turn to the state. We must minimize the risk to the taxpayer. So we have to find a way of ensuring that when that situation arises, we have a mechanism in place that can deliver funding and avoid a stability risk, but also avoid that the taxpayer pays. And that's essentially what the CMDI reform was about. So it was interesting for me, surprising in a way, to find that some of the issues that we had spotted in our sort of smaller to mid-sized banks arose also in what the US calls smaller to mid-sized banks, but in our world are pretty big banks.
Yeah, yeah. Did you, by any, just out of curiosity, did you get a call from anybody in Switzerland during the Credit Suisse? Because you have a bit of experience, LaShawn, and you can share your experience now with banks not working out.
Did I get a call? I did get a call. I won't tell you when I got the call, but I got a call, yes.
Okay. Just share with the 200 people here and the thousands watching online, because you have a lot of experience. What was the tenor of the call?
If I tell you that, you know when they called.
Oh, what? Right.
No, I think there was a sense of, I think there was a mixture of a stress and relief, I suppose. I mean, that's basically it. I mean, I think they had got it done, but it had been a pretty stressful occasion, as you would imagine. As has been said by Birgit, this was the first ever GSIB managed in a crisis. Now, I think, let's be honest, there were two things which surprised us about this: the AT1, which others have already mentioned. And what was interesting about that was to show that although our exposure was not so direct to Credit Suisse in the EU, there was an indirect exposure which was not spotted. And that came through markets we share. So there was a focus on direct exposures, that's where you look, but actually in a GSIB's kind of global public good. You know, we're all connected to a GSIB. And this was an indirect connection.
Through bond ownership, or what was the indirect exposure?
Through bond ownership.
Yeah.
Through, as it turned out, through ownership of similar but not exactly the same bonds. But they were both called AT1s. So that was a risk of market contagion. And the statement that was issued, I think, sorted that. I had a second point there, which I've completely forgotten now, but it may come back to me. But I think the overall feeling I had was that I was just glad it had been sorted on both sides, and that we were able to have a lessons learned afterwards, where we could identify where things could have been improved. But of course, if it hadn't been solved, we would have had a very different lessons learned, a much less relaxed one than we're having now.
Okay, easy first question from Alex Marmonton, who has just stepped in with Crédit Agricole. Did you own any Credit Suisse bonds?
No. Again, it's Axel, not Alex. I'm sorry.
Oh, sorry, Axel. Sorry, my mistake.
Yes, on the crisis, the banking crisis last year, the first remark I wanted to make is that there has been no real crisis. There's been some banks who had problems, situations. When mentioned the American banks, SVB, First Republic, etc., and the Credit Suisse situation. And these were situations that came from bad management, principally. And so this wasn't a crisis. And if I was to quote Super Trump, who did a wonderful album whose name is Crisis, What Crisis?
Yes.
There has been no real crisis. It was just individual situations that were to be managed and were managed efficiently by the regulators. So this is one of the lessons is that there was a good level of reaction of the authorities. And these situations are not quite comparable from the one side of the Atlantic to the other, because concerning the American situation, there was clearly bad management, but also probably bad regulation, lack of regulation, which is in Europe is not strictly the same because we have a regulation system which is really stronger than there. And the Swiss case, mentioning the 81 of Credit Suisse, is probably a specificity of the Swiss world, and not comparable to what would happen in Europe. And in that regard, I have to salute the initiative by the authorities in Europe to communicate very early after the Credit Suisse had this 81 problem to reinsure the markets. And this is nice. The need for very, very rapid communication in this crisis, indeed.
Yeah, let me bring in Manuel Preto, the Deputy Chief Executive with Santander Tota in Portugal. How important is speed? In other words, is 48 hours too slow to react?
I think it's a very short time frame. We've been on the acquiring side of assets from resolutions over the past decade twice. Banif in 2015 in Portugal, and then Popular in Spain and Portugal in 2017. And in the case of Popular, it wasn't even a weekend. It has to be done during the week, overnight. I think that the key here is not only what you have planned for a potential resolution, but then how you can sort it out during the very short time frame that you have. You're running essentially against the clock, because you know that if a bank reached the need for resolution, then something really bad happens, no matter why it did happen, but you're confronted with the need to decide and close some sort of resolution very, very quickly. Mm-hmm. And for that, the first thing clearly is information. Even with a great playbook that you might have prepared with all the possible scenarios and with the kind of resolution strategy that you might undertake. Something happened, I'm sure, over the hours, days, weeks prior to the resolution that has changed the balance sheet, the assets that you have to deal with. So having timely information and a correct assessment of what is on the table is of a very, very critical nature. Mm-hmm. Because if you aren't able to, as a resolution authority, of having that information and convey to the interested parties in any sort of acquisition that the confidence that the information you're providing is as accurate as possible, it's very difficult then for anyone to be interested and to be available and able to put a price for the assets, to put an offer in, and for the whole process to take place. So I think there are two stages here. One, which is timing is very short, so you need to have not only a playbook ready, but proper information to be able to push any sort of transaction through. And then the whole communication about what is going to happen, because these are typically banks which have lost confidence of the market, have lost confidence of investors, have lost confidence of depositors, and anyone who buys the assets has overnight to be willing and able to take an underperforming asset and stem whatever sort of liquidity drain that is existing, because typically you enter a resolution for because of liquidity and not because of capital. So you need to be able to stop that drain and to be able to pick up even some of the lost liquidity very, very quickly. Mm. So if you're not able to do these two things, it's very, very difficult to undertake a successful resolution. And this, of course, as you said, in a very, very short time frame, in which, of course, knowing that everyone is running against the clock, the stress keeps increasing, because you know that there's a deadline at which either you're able to do it as you had planned, or then you better have a very aggressive plan B to take care of the matter.
Annalie from the ECB, despite the presence of the SRB and the SRM, there was still a lot of speculation online about Eurozone banks. Some of them were being, 2 or 3 were being named very publicly on social media. Did that worry you?
As Claudia was saying earlier on, the banking sector is very resilient in the Eurozone. And one figure that we can remember when we started 10 years ago, I think the figure on NPLs was more than 1 trillion, and now it's some above 300 billion euros. Anyway, of course, one needs to be always vigilant. One needs to look at the risks of various banks. But regarding your question, personally, I'm a bit concerned about the amount of misinformation and disinformation we have in the social media, and also sometimes to the media as well. And so far, I'm not aware of any events attacking the financial sector. But as we know, there are some, say, governmental actors who are very active in hybrid warfare. And of course, that includes hybrid influencing. So we really should be prepared, and the banks should be prepared what to do if suddenly in the social media in different parts of say Europe, in different countries, suddenly, simultaneously, there's this negative false information about a bank. So the banks would really need to have its communication ready to come out and to give very exact information about its status. In such a situation, on the other hand, it would be a bit risky if the supervisor was to start to comment anything about an individual bank, because we know that the moment supervisors open their mouths, so then the investors start to doubt that something is wrong. But it's really, I would look at the banks, and they would really need to follow their what is written about them in the social media. And in some instances, we have asked our banks to actually assess the social media better than earlier on, because it's a risk that needs to be taken seriously. And of course, in the US case, some of what was happening there, the information was more or less correct, but now I'm really talking about incidents where the information is misleading, where it's disinformation. And I think this topic was also discussed in the World Economic Forum, where the disinformation is one of the major risks of tomorrow.
Birgit Rodolph from BaFin. Germany has plenty of regional banks. Did the crisis, or the mini crisis from last year, did that lead to an investigation to see if they were fully capitalized and had the right boards and the right governance to deal with any issues with the regional smaller banks in Germany?
I mean, I'm not on the prudential side of, within BaFin. I'm responsible for resolution and money laundering prevention, actually, and the non-allowed business. The prudential side, of course, is behind our large amount of banks in Germany. We, from the resolution side, have a different point of view. We look at banks and figure out which are relevant for systemic relevant. I mean, this is a key question. Are they systemic relevant? Yeah? And for example, coming back to the Swiss question, that the Swiss solution did what it was needed. It has calmed down the markets. Yeah? Maybe not the European solution with the AT1, but it did fulfill the necessary measures. In Germany, most banks are not systemic relevant, you know? As in other countries as well, which have many banks. So you have to pick the ones, and you have to see where can a domino effect might happen. Yeah? And we look at these scenarios quite intense, of course. Yeah? That's our job. Yeah? But I would like to, if I may, I would like to come back to one topic on the data, which you mentioned, because I think this is a very important fact. We have done together with the SRB in the last 4 years about 40 bail-in dry runs with banks, and several dry runs with the same banks over years. Yeah? And though the banks had to deliver the required data within 24 hours. And what we have seen is that it takes time to get to this level, and to get to the right level of data required in the right quality. We all know that banks have also sometimes issues with their IT systems, and it's not just you push a button and you have the data. It's not like this, especially not with big banks, and we're talking here about big banks. On top of these 40 bail-in dry runs, we did 9 fully fledged bail-in dry runs. And what does it mean is we work together, the authorities work together with the institution. So we start with the data delivery after 24 hours, but then we start really to do the calculation on the bail-in tool. What are the impacts on accounting? Yeah? What are the impacts on regulatory and on tax? Yeah? What are the impacts on the business model, because this might change? Yeah? And what does it mean to this bank? Yeah? And then in the last step, you prepare the external execution of the bail-in. Yeah? That doesn't even sound easy, and it's definitely not easy to do all these things in a very short time frame. It's a kind of very important preparation. And what we learn from all these exercises with the banks are that progress happens gradually over time. And performance, and that's a very interesting point, can fluctuate. So a bank which is good this year might not be as good next year, though that can change, because the business model may be changed. And each bank is unique. And also, they do not advance in the same time other banks have advanced before. So it's like, that's why you can have playbooks, etc., but it's always individual. It's an individual business which we are in, which also makes it so interesting.
Okay, before we move on to the banking union, could you put up the Slido QR code, please, one more time? Because we got a question in. Yeah, there you go. We got a question in from a Mr. Anonymous, and his question is: could the Credit Suisse merger have been done without the post-Great Financial Crisis (GFC) reforms? Sean Berrigan.
Probably not, in fact. I mean, yes, it could have been done, but it might have been done differently. I mean, what they did, interesting enough, in this merger was they followed a large part of the resolution framework we had, but just not fully. So they had prepared, they followed a lot of the decision-making processes that were there, but in the end, they opted not to go for the resolution option, which would have resulted, of course, in a different allocation of losses. They went for a merger option, which resulted in the chosen allocation of losses that they wanted. But I think without that resolution framework in place, it would have been a much more difficult process. I mean, if I think back to 2010 in Ireland, when we were there, where we had no legal framework, we were facing many of the same issues they faced now. The Irish banks were not GSIBs, but we faced many of the same issues about how you treated bondholders in a hierarchy where they were at that time.
And of course, the Irish government had provided a 100% guarantee.
At that time. Yes, but I mean, even so, I mean, legally speaking, the senior bondholder was equivalent to the deposit holder. So there was a lot of discussion around bail-in in those days, but it was legally impossible.
Yeah.
So I think we have to hope something would have been done to solve it. But I think it was much easier for them with the resolution framework, even though they did not carry it through to its final point.
Okay, keep the microphone there now. We're going to move to banking union. Are you disappointed at the pace at which banking union has been implemented?
Yes.
Okay, next question. Tell us more.
Well, we've been doing it for quite a while, let's face it. And the story of banking union, of course, is that there was a crisis. There was a huge need to take steps to restore trust in the system. And so big steps were taken under the influence of the crisis. It's the usual story. So at the early part of the crisis, when the pressure is on, big decisions are taken. And let's face it, very big decisions were taken in many fields. You can think of the ESM and all of these things. But in this particular field, you had the creation of a single supervisor, something which, by the way, the member states before the crisis said was totally unnecessary and impossible. But it was then done within a year and up and running within 2 or 3 years. Then we put together the single resolution board. Again, something which I guess before the crisis we would have been told was impossible or unnecessary. So these were, I remember I used to speak in those days that in EU time, this was the speed of light. Okay, we were moving. To do such a thing in 2-3 years was just unimaginable. I think, though, as the crisis has kind of faded away into memory, the pressure has eased off.
Are we moving at the speed of sound now, or even slower than that?
Are we moving?
Are we moving? Okay. Glacial.
We are moving, but we're moving pretty slowly.
Okay.
You have to be up close to see it.
That's glacial.
But I think we shouldn't underestimate what we have achieved, though. I mean, these two institutions are, in my opinion, the bedrock for the future, integrated banking system of the Union.
Yeah.
If we don't have these institutions, there will not be an integrated banking system. We're not there yet, but they're a fundamental part of it.
Manuel Preto from Santander Tota in Portugal. Would you like to offer mortgages in Ireland or Estonia? Or other countries? I just named 2.
Listen, I think that the model that we have that's specific to Santander is that we have units in several countries we operate. So the cross-border business that we do typically is linked to the companies and the individuals from the country where we are based, and typically with retail banks which have a significant market share in these countries. So it's clearly not something that is or has ever been on our mindset. But I perfectly understand, the level still of barriers for cross-border business in banking in Europe is still significant. And that's very, very clear.
That's because regulators want to keep a tight control about lending, don't they?
I think it has to do with several things. I think it has to do with that. I think it has to do with the fact that you're still dealing with different countries, and different countries with different cultures, different ways of doing business, different laws that apply from it's not just the fact that a bank can or cannot operate in each country, but even the way products are set up in each country is different. So you start going into the fine detail of what is the banking market, and it is very different from country to country. That doesn't mean that you can't have businesses and products that you might sell or commercialize across several countries. But there are still very big chunks of the banking business which is still very local.
Axel, can I bring you in? I don't know whether Crédit Agricole is in Ireland or in Estonia, but would you like to sell financial services? And isn't the problem that your regulator will say you won't be able to get your hand on the asset if someone doesn't repay that mortgage.
I don't think I catch the question. Could you rephrase it, please?
The lending of mortgages across borders, isn't the problem that you cannot necessarily or legally get your hand on the house, in this case, or the asset, if something goes wrong? Otherwise, there would be cross-border lending.
Well, I think I won't be entitled to answer that question. I'm sorry, because I replaced Mr. Grivet in the last minute, so I have to...
We can pass it on to Annalie. Isn't that the problem? Not being able to get your hands on the asset. That's why cross-border mortgage lending is just not possible at the moment.
Yes, cross-border mortgage lending is pretty limited, as we know. Also, I think it's from the point of view that banks also operating in their home markets know the markets better. When it comes to getting hold of the assets, I must say that personally I'm not that familiar with the problem. I wouldn't imagine it's not impossible either, but that is something that one would need to look into. But when you were discussing this earlier on about the banking union, so I think that time should little by little be ripe for having this full banking union with the EDs. I understand that at the beginning some member countries were a bit hesitant because they thought or they understood that the banking supervisory standards were not similar in various countries, and in some countries the banks were not in such a good shape. But now, as we are approaching our 10th anniversary at the SSM, so I think that it's really prime time to start to change the views and to understand that only through the banking union we can reach a truly integrated banking market in Europe.
Birgit, you shook your head when I suggested that you wouldn't be able to get your hands on the asset.
Yeah, I think it depends on the country. So there's cross-border mortgage business in Europe. I know a couple of banks are doing this. You have to have first you have to have a distribution network in the country you want to do these kind of, if you talk about residential business, you have to get access to residential creditors asking for mortgages. Yeah? I think that is the main problem, that this kind of distribution is not there. But and yeah, in some countries there might be legal issues, but this is not a key issue from my point of view. Yeah?
Okay, well, what about the fact that in Malta, they pay, the average mortgage for new mortgages is 1.89%, and it is 6.2% in Latvia in the Eurozone. That is such a divergence. It means that the people in Latvia will say, I want to go to a Maltese bank, but that's not possible.
I think we are back to business models and risk you want to take on your business model, and which countries you want to do which kind of business. Yeah?
Sean Berrigan, you wanted to get in on that.
No, I just wanted to come back on this collateral, access to collateral. I mean, there are, aware at least, significant differences around Europe between the time in which you could access collateral. Many of those have been narrowed now. There were some member states we will not mention where it took a very long time to access collateral, but we don't mention them now. But the bigger issue I always found in terms of cross-border provision of mortgages, i.e. not establishing but selling it from one country to another,
yeah, that's what I mean,
is due diligence and due diligence costs. You almost need to have the distribution network in the country. It's just too costly to do it. So this is why they don't do it on a cross-border basis. They can do other services on a cross-border basis. And as for why interest rates differ from one country to another, well, this can also relate to the local conditions for capital as well.
And can that not be streamlined and unified?
No, because it depends on the risk. And here I'm getting into areas I shouldn't. I see Claudia. I'm peeking my eyes definitely on Claudia, so I don't make any mistakes here.
She's still smiling. That's okay.
She's still smiling. So it's okay. It's to do with the risk profile of the banks concerned, how much capital they hold, and that's based on a whole range of things, which I'm not going to get into, but that varies from one country to another.
Okay. I'm going to move on now to other topics. I'm going to talk about climate change because it was referred to a little bit earlier, and the impact that climate change might have for banks and for the wider economy. Manuel or Axel? I know, Axel, could you take a question on climate change?
I can. Please answer. Take a question.
Well, just what preparation is a bank as large as Crédit Agricole doing for climate change, for the fact that there will be more flooding events, more fire events, potentially earthquakes, who knows? Mass migration, that's all part of climate change.
Well, I'll give a general answer on that. I think the climate change is clearly a risk we include in our risk framework assessment, so it's important to have this in our framework to identify these long-term risks. And also we have upcoming regulations on that subject that will reinforce the system and the way we apprehend the climate risk in our portfolios and in our activities. So this is important for the European system, the banking system, and we will, of course, apply these regulations like everyone. So that's for now the answer I could give concerning Crédit Agricole.
Manuel from Santander, here's a hypothetical. Should banks refuse to lend to people wishing to buy an old, drafty, cold, poorly insulated house?
I think banks need to be sure that the money that they lend, the prospects of it being paid back is quite high. You know, I think we can't never forget that where the money comes from that banks are lending. You know, it comes from depositors which have trusted banks, and that's the main source of funding for European banks, depositors that have trusted banks with their savings. So the risk management on the part of banks has always to come back to, you know, am I lending to someone in which the prospect of being paid back on time and smoothly is significant? I think that is the main issue. Then you can get into whether or not banks and how can banks help green transition and financing the huge amount of money which it will be needed over the next years and decades to do that. And I think that is where banks, I think, are starting now. And I think it has to do with a whole range of things, from being able in their IT systems to be able to have the information to differentiate between the kind of lending that they are providing and what in terms of the impact on climate. Secondly, being able to, in terms of the portfolio that they already have, to differentiate in what will be long-term lending or what in the future will need to be diverted to other sectors, just because society will divert its investments elsewhere. And then even on the product basis, you know, can we help in terms of having more attractive product propositions to things which help out in terms of climate change? That's a different area. But, you know, going back to your question, I think that we can never forget, you know, what are we entrusted with, which is depositors' money, and that is the safeguard above all that we need to guarantee.
Okay, Annalie, I've got a question that came in from Slido, also didn't give their name. A lot of shy people out there. Do we need another EU or Eurozone crisis in the banking sector to complete EDIS, Deposit Insurance Scheme?
I do hope not. Of course, I mean, what has happened in the past, we know that when we have a decent crisis, it helps to make changes, but I wouldn't be that pessimistic, because as I said already, that soon we have had 10 years of the SSM supervision, and the banking sector is now much more resilient than it used to be. So we would need to also understand what are the benefits of the EDIS and banking union. I know that it's not that easy. There are some members who are not that, say, positive, but I personally am positive that it wouldn't take that long. I hope I'm right. Most likely John knows more than I do, but I do hope that we do not need to go through another crisis.
Okay, Sean Berrigan, same question. You spoke before very eloquently about how much the speed of light in terms of change in the aftermath of a crisis, and how we're now at crawling pace. Maybe we need another crisis.
I think I've been asked this question before in this actual forum, maybe last year or the year before. So
Déjà vu.
I better make sure I give the same answer. I really don't like this discussion about crisis as a means to make progress. And I've said it before, and I'll say it again. It is the most inefficient way to make progress, that you take a huge hit and all this damage, and then you make the steps you should have taken before. So banking union in itself so far is a good example of that. Before the crisis, we had an integrated banking system, but no architecture for banking union. After the crisis, we have the architecture for banking union, but we don't have the integrated market anymore. The hit was the integrated market. So I don't know whether it's true or not. Maybe it is, but I hope it's not, because it's an extremely inefficient way to make policies. We should, put in place the things we need before the crisis happens, rather than after the crisis happens. I don't think it is necessary, though. I think the interesting thing about the CMDI discussion is that it is revealing that although the CMDI proposal, in my opinion, and I would say this, is brilliant, I'm looking at one of my staff members out there who's responsible for it, it's a brilliant piece of work, there's still a hole in it. And that hole is what we do if national DGSs are not enough to cover the costs. Now, we have filled that hole by a specific bridge, which those of you who know it will know, a bridge to the Single Resolution Fund. But for me, this is not the optimal approach. The optimal approach would be to have a European deposit insurance scheme available to fill that gap, so that if the national deposit guarantee scheme is not adequate to meet the requirements, EDIS would step in and not the state. So I think even in discussing CMDI, those who have issues around EDIS are beginning to see more clearly how it fits into the system and how it meets these two basic principles of the EU resolution framework and the global resolution framework, which is that you must preserve financial stability as the primary goal, and then you must do it in a way that minimizes to the maximum, maximizes or minimizes the risk that taxpayers have to pay.
Manuel, do you want to get in on that, on CMDI? You probably don't want to speak about that.
Sure.
Yeah.
See, I think that we're clearly supportive that the resolution framework be expanded beyond the largest banks. And I think that there are pros and cons to when bringing on board the smaller banks, how you use the funds which were created with different contribution methodologies, and that has to be addressed or should be addressed. And of course, that I agree that without a public liquidity backstop, whatever it is, it's very difficult then to have these resolutions to operate, because again, you come back to what we were discussing in the beginning of this talk, which is when banks typically fail at the speed that they fail, it's because of liquidity issues. Typically, that is the trigger, irrespective of which problem surfaced beforehand, whether it was a business model problem, a capital problem, whatever. But the trigger for the resolution and for the need for a resolution typically is liquidity. So unless that is well sorted out, then there's always going to be a problem in implementation.
Okay, Birgit, can I bring you in? Do you want to comment on the CMDI, or shall I put a different question?
What a question is this?
Well, it's in relation to climate change. It's,
I mean,
I can give you the question.
no,
We've just got a question from Slido. I can put it.
Actually, I take a couple of or maybe I try to give some comments to CMDI and those issues around. I mean, let me come back to what I said at the beginning about SVB and about those investors from the venture capital. I picked this example not without a reason. Yeah? I mean, I'm convinced that depositors are not all at the same vulnerable. There are differences in depositors. I personally make a difference as a private person or an institution or an institutional investor where I just expect a higher knowledge, higher financial knowledge, and knowing in what kind of papers I'm investing money. So I think we don't need the same level of protection for all kinds of investors. I think we need a strong and credible deposit guarantee scheme. But I also think if we, and that is actually have what the CMDI is also asking us, do we really want a higher coverage for everyone? If the answer is yes, yeah, then we have to be honest and transparent that that means that to the banks, higher bank levies to finance this coverage. So someone has to finance this. Yeah? And this will not be, there's no free lunch basically. Yeah? You can do this, you can ask for this is fine, but who's going to pay for it? Yeah? And that, I think we have to be honest. Yeah? So I don't mind that we increase the amount of banks where we focus on a potential resolution and plan for the resolution a little bit. That is fine. We see this especially with these mid-sized banks, where it's sometimes hard to define: could cause this bank a failure of this bank a domino effect, yes or no? And if you have a question, then in this case you say better safe than sorry. Yeah? So you better add one bank more than one bank less. I think we're all on the same page of this. But I disagree to make the access to the SRF funds or the DGF funds easier. Yeah? I think, and we have said this before, a resolution must foremost be financed by the equity holders. We talked about the Swiss case, yeah? And the creditors of the failing institution. That is strong opinion of myself, and therefore I think it's very important that we have built strong MREL resources and build up subordinated MREL resources. And we saw this again in the Swiss case. Yes, it was not a resolution, but it could have been a resolution. And the subordinated TLAC money was in place. It wasn't used, yeah, but it was partially used for the merger. So,
yeah. Birgit said there's no such thing as a free lunch. That is not true today. There is a free lunch and it's coming up very shortly. Now, I want to see if anyone in the audience has any questions. And remember, as they say in Scotland, shy bairns get nae sweets. So, if you've got a question, put up your hand, maybe give us your name, rank. Oh, we've got a question here in the lady, blonde hair, got a question. We have a microphone making its way to you. If you tell us, ma'am, who you are, who you work for, and then your question, and if you want someone specific to answer it.
First of all, I probably say that I'm really proud and thankful for having opportunity being here. And I must say I'm brave because I'm coming from a country which we faced and focus on crisis almost on daily basis. I came from Bosnia and Herzegovina. My name is Neda. And I'm not from banking sector. I'm a stakeholder. And I'm taking some steps by me alone and other to make some changes in my country. Unfortunately, it's a heavy job. And this is something like a question for all of you, maybe for Dominic and Miss Claudia also. Because what I'm really wanted to know, you know where I am. I'm not in European Union. And what we have in Bosnia and Herzegovina is almost jungle. Why I'm saying that? Because we have some influence of European Bank. We have some project that we can participate in, but still we don't have enough communication with Eurobank and any other sector. So if is any possibility to people from Bosnia and Herzegovina, an institution, not with government, but independently, do some changes in conversation, in communication, by your guidelines or something, to make some changes. Thank you.
Thank you. That's Ada from Bosnia. I presume that applies to all nations outside the Eurozone. Sean, any thoughts? You may not have a thought. I can pass it on if you're stage fright.
I rarely suffer stage fright, but I have to think about the question. I mean, I think Bosnia and other countries are now on the road to, ultimately on the road to accession. That's a process, it's a two-way process where the future member state has to prepare, and we have to help it to prepare to align with our framework. Actually, I've had conversations with other countries, not yours, where I have to make this clear: this is not an exam. This is not something where the union sets out an exam and the member state has to sort of pass the exam to get in. What's actually going on here is that we want to use our framework to prepare the future member state, so that it can survive, not just survive, but prosper inside the union. So this process you're talking about will now start more and more, where I don't know whether we will be discussing directly with the people in the country, but certainly with the authorities, we will start a process where we will use our framework to help Bosnia to develop, to prepare itself for future entry, so that when it enters, it's not just, as I said, it not just survives, but it prospers in the union. So I think that process is coming, actually.
Thank you.
It's a positive outlook. Now, we're running short on time, so I'm going to move along. Annalie, can I ask you about cyber threats? Dominique Laburex was talking about cyber posing new types of risks. Are you seeing that as well?
I couldn't agree more. Of course, they are not new types as such. I mean, we have had cyber attacks for, well, centuries. But anyway, they are now more frequent and more fatal. Fortunately, we haven't had any fatal attacks towards the European financial industry as yet, but we need to be prepared. We have an increasing number of DDoS attacks, but we have also this ransomware where you really are blackmailing money. And they are getting also more frequent. Unfortunately, then in this sector, we have those, as I already mentioned, about these governmental attackers who have all the resources, who are very sophisticated, and who just have the capacity to hack or attack different sectors of society. The banking sector is maybe one of the most resilient in this when it comes to cyber, but of course banking sector is also dependent on other sectors which are less resilient, like electricity and telecommunications, and also third-party service providers, which do not have that kind of resilience. Of course, DORA will help a bit, but really each bank needs to be more prepared. That's why we are, at the moment, as Claudia was saying, we are having this cyber stress test. We are really looking at how the banks would respond and recover, and some banks really need to have a sort of IT recovery tests. in order to see in what kind of shape they are. And I think this is one of the exercises. I mean, banks do not like all the exercises that we carry out. I wonder why. But I think that this is one of the exercises that banks should really also take all the benefit out of it, because if there are weaknesses, so they should also need to become aware and correct, I mean, those weaknesses, because this is something that we need to do, and it's a must. I mean, there's no option, it's a must.
Okay. Birgit, do you want to get in there on cyber threats?
It's a must,
Okay.
as Annelies said. Yeah.
Axel, Dominique said he won't be coming to you, the banks, looking for money this year. You must be very pleased about that. When you get a call from the SRB, do you say to yourself, oh, what do they want now?
Of course not. We're really delighted to have our colleagues from the IRT. And we have day-to-day relationship which are really good, I have to say. So I have to insist on the fact that we are really keen on working with the SRB. And talking about operational readiness, I think it was one of the topics of the roundtable. We are at the end now of the resolution planning phase, and so there's been a lot of work done. And I can mention that in our group we've run 10 dry runs on these exercises that the SRB wants us to do, and we are keen on making them. Dry runs on the bail-in dataset, which is necessary to have the data to bail in our liabilities. The dry runs on the valuation system, the financial market infrastructure, and we also covered other topics as communication, operational community, etc. So there's been a lot of work in this resolution planning phase, and now we are entering in a new era, and the new strategy of the SRB is welcome in that regard. And I think I would like to give some our point of view on the way these relationships with the SRB could be in the coming years. And these are summed up in the 3 Ps, the P cube. Those are the pragmatism, the proportionality, and the predictability. These are things we shared with the SRB for the strategic review which is coming, which has been announced. And so to give a few examples concerning pragmatism, there's a number of subtopics on which we discuss with the IRT to find solutions to have less heavy procedures on things like waivers, on recurring waivers on subsidiaries, which every year have to be done from scratch, and so we could perhaps think about simplification in that matter. Concerning proportionality, I mentioned the bail-in dataset. If we cover the entire balance sheet size with every liability in our balance sheet, we think it's a quite ambitious target. And so for now, we have a perimeter in that exercise which covers a lot more than 8% seal-off. And so technically, normally, if we have a bail-in in our group, we shouldn't go above this level. So we think the SRB could think about having a limited perimeter on these exercises. And the third one was predictability. So we have time now to enhance our system and our resolution tools in the banking system. We have to work together to have a step-by-step approach and to reinforce our systems in a pragmatic way and with predictability, because sometimes, I have to say, last year we had a liquidity exercise which was a little bit short-noticed for the industry. So we have to work to better be prepared for these exercises. These exercises are, for some of them, huge investments. So we are making them to enhance our resolvability, and we have to talk together to have this step-by-step approach.
Okay. and that is a perfect way to end. Look at the time. Our timing is absolutely perfect. And before I hand back to Susan, I want you all to please thank our incredibly esteemed panel for joining us. Sean Berrigan, Manuel Preto, Annalie Tuominen, Birgit Rodolph, and of course, for stepping in at the last minute, Axel Marmonton. Thank you. Thank you. Susan.
Thank you very much, Joe, and a big thanks to all our panelists and our other speakers this morning. Now it's time for a well-deserved lunch break. For those of you here with us, lunch will be served in the Riverside area, and you can just follow the signs. We'll start again at 14:30, at 2:30 sharp, with our parallel sessions. So you can just follow the signs at that time to the room for the session that you signed up for when you registered. You will see signs directing you. As a reminder, the Emerald Journey session will be here. It will be streamed, and the other two will be made available via video after the session. With that, thank you very much, and bon appétit.
Well, Sean, thanks very much. Thank you.